Hello and welcome to Theo Trade. My name is Doc Severson and this is the Theo Night Report for Tuesday, August 23rd. I'm going to start out tonight's report by looking at the spiders or the S&P 500 ETF that is so popular. And on the bottom study down here, I've got historical volatility, which is also known as the realized volatility. Now, this is the volatility of the price itself and not the option chain. The option chain is measured in implied volatility. So this is historic volatility. And right now, what it is showing, if you look all the way down in the lower right-hand corner here, is that the SPDR 30-day realized volatility or historical volatility is showing 5.1%. This is about the lowest level over the past 20 years. Now, what does this really mean in terms of actual daily movement? Well, if we take 5.1% and we divide that by the square root of 252, and the reason why 252 is important is because of the number of trading days in a year. And what we're going to find is that equates to 0.3%. And this is the average daily move is 0.3%. So we're not getting 1% moves. We're not getting 0.5% moves. We're getting 0.3% moves on an average daily basis. And you can see because of this is so tight up here. So if we zoom in on the recent price action here, you can just see how after the initial Brexit low, we came screaming up here and we basically put in a base on a base. So this is a base on a base pattern where we have literally a very small range and then a breakout to another range and an attempted breakout today, which is rejected. So what has the market done when it's been in areas of volatility or realized volatility that are this low? What is it? Does it mean that we're going to have a crash tomorrow, or does it mean that we're going to continue? So let's go back and review how the market has handled this over the past 20 years. Now, the last time we saw anything close to this low of a value was at the end of 2014. And you can see that it has a very strong 2013 and followed up by the first half of 2014. And it wasn't until we got into the October, the whole craze around Ebola, that we started to see some real volatility come in for the first time that year. So after that move, we saw a very rapid V bottom and we got up to a very quiet market, much like what we're seeing right now. Well, ultimately that led to a very sharp decline, another V bottom type of movement here. Now, some of this can be attributed towards holiday volume. A lot of times we'll see around Thanksgiving, we'll see very, very quiet markets, but after such a big move like this, very quiet markets, all of a sudden it started getting very noisy after this. So this is very important because we went from a very quiet and trending move here, and it was very quiet and trending before that whole Ebola scare. All of a sudden we started going into a sideways and volatile market. So that was a very important character change that occurred back there at the end of 2014 and really led to about 1.5 years straight, almost 2 years of sideways movement in the markets. Okay, before that, another very low value was here around the early part of 2011. And remember, this whole rally got kicked off back in 2010, around August 2010. And the reason why it got kicked off was because of Ben Bernanke speaking at Jackson Hole and for the very first time announcing quantitative easing and basically saying, yes, we're not kidding, we're going to print money and we're going to shove it into the bond market, and where it goes after that, we don't really care. So as we finished up 2010 and got into 2011, we started getting into a very similar type of movement here where we're just getting into these little base on base stair-stepping moves. Little base on base stair-stepping moves. Higher, 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 and eventually it sort of squirted to the upside. This is very common to see something like this where we have basically a channel sitting up like this, and we see the price actually squirt out the top of the channel. something that's not really taught in any technical analysis textbooks. Remember that rising patterns like this are supposed to break to the downside. Well, eventually they do, but many times we see patterns squirt out the top of a rising pattern these days, and this is because of people chasing after the move. Okay, so after that, we eventually did see a little bit of corrective price behavior, but eventually that rectified itself back up to the upside again. So markets can go in these types of moves, these little base on base, stair-stepping moves, for quite some time before they finally exhaust themselves. Now, before that move in 2011, we have to go all the way back to around the 2006-2007 timeframe, where we got some very, very low realized or historic volatility. This whole rally that we saw here off of the summer bottom in 2006 was pretty much like this. So going through this type of move, we can see the same type of base on base behavior, stair-stepping price action, very, very low realized or historic volatility. And this continued all the way into the early part of 2007 before basically we got a shock. This was the whole carry trade shock that was also precipitated by Alan Greenspan predicting that the market would fall into recession. Well, he was pretty much right. He was a little early, but many times they are. So this whole 50-point handle kind of shook things up for a while. But ultimately, the market did recover and go back into the same type of move to the upside. Right, so here we go. So the market did recover from this and started setting up higher highs and higher lows and back to that kind of base on base stair-stepping price action with very, very low historic volatility. But the point that I want to make here is that this can go on for longer than people can believe before all of a sudden we get a shock event. So this is all kind of saying the same thing here, is that when we see these very, very low volatility environments, they can stay going like this for quite some time, longer in fact than we believe that they can. But ultimately, a lot of times we'll see prices kind of running away usually before they finally do come under correction. Now, over the coming weeks, what you'll see us talk about a lot more is how to set up proactively these long Vega trades that can take advantage of something like this. You know, take advantage of price movement to the downside as well as a big spike in implied volatility. Obviously, we could just buy puts, but the problem with that is that they can be very expensive to continually buy puts again and again and again. And so you can try different forms of financing those, or you can set them up as sort of a self-finance trade to begin with. So you'll see a lot more from us in the coming weeks on something like that. Now, in the meantime, until we do get that price movement, we're going to continue taking advantage of this type of stair-stepping price movement. And one way we can do that is with another long Vega trade, which is the at-the-money calendar spread. So this can be our replacement for the old iron condor, the old standby, that right now it's just a very, very dangerous trade to be placing because of the fact that we have such low implied volatility. So eventually we'll get a mean reversion in not only implied but also realized volatility, and that is going to step on an awful lot of iron condors out there. People that are looking at this flat market right now and saying, hey, it's a flat market, let's just trade iron condors. Well, all those profits will be given back basically in one trade as the iron condor gets stepped on. You know, usually the bottom leg for those. Sometimes the upper leg first and then the bottom leg. So been there, wrote home about it, got the t-shirt, been through that all before, and just not a whole lot of fun. So if I look over the last 15 years or so, most of my biggest losses have come on downside condor legs getting stepped on through this type of volatility. So this is what a calendar spread looks like for something like deer. So now let's go up to the chart for this and show why we got into a trade like this. I should correct myself here. I didn't take this trade, but this is one of the examples that we've been using lately. It's like deer. So deer, what we want to look for in deer is a strong reaction from this, such a linear move that we basically have bottomed out the choppiness index down here on the daily chart. We have an uptrend on the monthly and the weekly charts. That's good. So we want that type of quiet and trending environment to the upside, right? Even though this is not necessarily quiet, But we also have the price jammed up against a resistance point here. Now, there's no law that says that it can't fill this gap up here to 90 or drop down or anything like that. All we're trying to do is to stack our odds that for the next couple of days, the deer is more likely going to stay here at this level after just reporting earnings that go rocketing higher from here or pulling back again. It's more likely to kind of just stall out for the next couple of days in that price area. And frankly, with these types of trades, that's really all we need is about 2 to 3 days of mild price movement in the same area. So here's another one worth looking at is Best Buy, as the price has come up off of earnings and has jumped right up to about this level of resistance right up here at 39. So looking at this one on Best Buy, again, only after about a day's worth of trading, it's already showing these realized profits at this area. So these are trades where we don't have to necessarily spend a lot of time in here to get a reasonable return of about 10% if we do this right. So if we totally qualify this trade, and this is not only from a price perspective, but also from an implied volatility perspective as well too. So we have to make sure that there's not too much of a differential between what we're buying and what we're selling in the calendar spread. Okay, that is it for today's report. Thanks for listening, folks, and we'll see you tomorrow.